Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stocks stalling in today's trade after the S&P 500 reached an all-time high in Tuesday's session. That was driven by a rally in the chip makers. Meantime, Meta's record 20-day run finally coming to an end after the social platform added more than $320 billion to the company's market value.
Plus, investors are grappling with Trump's latest plans to impose tariffs on about 25% on cars, semiconductors, and medicine imports, with an announcement coming as soon as April 2nd in a move that would represent a widening of his trade war. Now, Trump has previously announced 25% tariffs on steel and aluminum that are set to take effect in March. His latest comments are his most detailed yet in specifying other sectors to be hit with levies.
And traders' attention also focused on Federal Reserve meeting minutes, which could offer clues on the monetary policy outlook. Several officials, including Governor Christopher Waller and San Francisco Fed Chief Mary Daly, have signaled rates will stay on hold until inflation slows significantly.
The U.S. stock rally fading today as President Donald Trump threatens 25% tariffs on foreign cars, semiconductors, and pharmaceuticals. This as the 10% additional tariff on China is in effect, and tariffs on steel and aluminum are expected to take effect mid-March. We're taking a look at futures here this morning. They are down across the board for the Dow, the S&P 500, and the NASDAQ. Fractionally as they may be, there's a few things, of course, to take away with some of the latest announcement and the details that are starting to be clarified around what would be additive here and the industries specifically that would be impacted here. And you think back to what Jim Farley had said, who was the Ford CEO, just a few days ago, talking at an investor conference about a week ago, saying a 25% on Mexico, Canada would, quote, blow a hole in the U.S. industry we have never seen here. Worth noting as well that Ford was one of the companies that actually donated to the inauguration fund for President Trump as well. They had anticipated that there would be tough tariff talk, but the extent of which unknown at that time, now being a little bit more clarified.
Yeah, it's interesting, particularly that we are seeing this kind of ratcheting up of tariffs. If we pull up that calendar again, you can see, as a reminder, we already have that 10% tariff on China, proposed tariffs on Mexico and Canada set to go into effect early March. As a reminder, that was delayed by a month after negotiations between the U.S. and Canada and Mexico. They got a little bit of a reprieve with a month there. We also have steel and aluminum coming up. If we can pull up that full screen there, you'll be able to see that. Having said that, it is interesting that the market continues to kind of slough off any potential tariffs here. And again, you can see that 25% tariff on steel and aluminum, cars, drugs, and chips. That sector in particular in focus because that is the news from this week. Trump talking specifically about tariffs to come on those sectors. But again, the market's sloughing that off. We're not seeing a huge sell-off in those car names, in pharmaceuticals, and certainly not in chips, which drove the S&P to another all-time high yesterday. So is the market saying that Trump is just using tariffs as a negotiating tactic, or is the market missing something that could be more sinister? And that is the key question for investors moving forward.
Yeah, I was looking at a note from Macquarie yesterday, and they said despite uncertainties surrounding some of the new immigration tariff policies, they actually believe that there's more favorable environment for other areas of the market that they're looking at here. So it does speak to your point of how much some of the biggest asset managers and money managers out there are saying until there is a more widespread or even long-standing impact, and that would take us into the conversation around how long are the tariffs actually staying on the table until a negotiation is actually coming to fruition. That is something that could have a larger GDP impact, and until they see that GDP impact, it's unlikely that we would see a major revision from some of the largest money managers out there, as we were mentioning a moment ago. But in terms of some of the GDP impact, I was looking at the Tax Foundation and some of the analysis that they were running. Even prior to the latest tariffs that were announced, they were already anticipating that there would be a potential net negative headwind to GDP of about 0.3% here with the tariffs that were already talked about and those that are still on the table from the first Trump administration. flowed through the Biden administration and are still something that industries are having to navigate through.
And that's significant given that one of the three tenets of Treasury Secretary Scott Bessent's approach to tariffs is driving growth stateside. Is this idea that tariffs will lead to more U.S. production, but estimates from the Tax Foundation indicating that GDP will be put under pressure due to these tariffs. So a question remaining about which of those two is going to come to fruition and where the priorities will lie after negotiations, where things will kind of net out. But let's turn now to the impact of potential tariffs on the chip sector. President Donald Trump threatening those levies of 25% or more on semiconductor imports. So joining us now with more on this, we've got Maribel Lopez, the founder of Lopez Research. Maribel, it's great to have you on here. I want to talk specifically about the impact of these tariffs on some of these chips names in particular that drove the market to all-time highs early this week. Is the market missing something sinister when it comes to tariffs, or is the market right to kind of be sloughing off any potential negative impact?
This is really an opening volley by Trump to say he's really serious about tariffs. Tariffs will happen. The amount of the tariff and what the negotiation standpoint is still unknown. So this is like, hey, I'm throwing it out there. You're going to come to me. We're going to have a negotiation. And we're going to try to figure out how you are going to invest more in America. And that's really what I see as a statement that Trump is making here. This is why we're looking at April and not tomorrow. If we're looking at April, there's plenty of time for someone like TSMC to call and say, hey, here's how we're feeling about investing more in foundries in the US as an example. Same for Samsung and other companies that already build chips here, but not at a very significant standpoint.
Are there industries that you think are more likely to be successful making sure that they're included in an exemptions or an exclusions list as they try to vie for the ear and the mind of the president?
So some companies actually already have a strong foothold. You mentioned the automotive industry. If you look at somebody like BMW, they already manufacture a significant portion of what they sell in the U.S., upwards of about 50% in the U.S. So they actually have a better negotiating ability than, say, Samsung, who does manufacture some goods here, such as some of their home products, but not necessarily enough. So we're seeing that it is wildly unevenly distributed across the various companies and across the various sectors. But I think the call to action for everybody right now is to try to figure out what they can do to make a play to say that they're going to invest in America to either create manufacturing jobs, to create investment in some other type of category that we would consider as beneficial to the economy. And this is why the fund managers are not overreacting to the statement at this point, because they understand at this moment, it's still a negotiation.
So it sounds like you think the market is right to view this as that negotiation, not as something more serious. But do you think that the Trump administration is kind of angling towards universal tariffs by throwing out these larger numbers like a 25% to kick off those negotiations? And could there be risk associated with that?
I think they're incredibly serious about tariffs across the board. I think this is definitely a statement that says no industry, no country will remain unscathed by tariffs, and that you have to have a plan on how to work with us. We are serious about rebalancing, whatever they think rebalancing means, but they have definitely indicated that they are serious about it. So the real thing to watch here, to your earlier point, is when do they come in effect? How long do we expect them to be in effect? And what would be considered a sufficient and necessary investment in the US? But clearly, there's many companies that are looking at this saying, if you're a auto manufacturer, say in Japan, if you are a semiconductor manufacturer in Taiwan, you're looking at what could this do to my profitability? How do I find a way to make sure that there's a sufficient investment that we don't end up with a 25% tariff, which is a significant number for any company's.
Maribel, almost a two-part question here. Number one, as you think about the companies that are kind of bracing for this and trying to figure out how to navigate around it, what does that mean in the near term for their innovation pipeline? Do they become a little bit more wary about how they can generate some of these cross-border business opportunities at the same time as they're making sure that they're investing further in an R&D pipeline? And then I guess on the other side of this, as they're thinking about their relations in other countries, how do they also need to strike a balance of saying, okay, yes, we agree with you, President Trump, but also going to other administrations elsewhere around the world where they're trying to operate and say, hey, we're hoping that you net out a good deal here too, as we're trying to operate in your region?
So I don't think this was unexpected. I think the issue, if you look in the semiconductor space, there's a tremendous amount of innovation that is not related to the actual manufacturing, which is really what, say companies like AMD and Qualcomm sell. And they're looking at companies like TSMC for manufacturing. Now the question is, how do we think about redistributing that? And is there a path where we can say we're not going to disrupt how we actually manufacture, and we can still manage to migrate this forward into keeping the innovations that we're really good at, but leveraging the global economy? This, I think, is actually a very tricky balance. So we're looking closely at how fast, for example, you can build a foundry. Even if you wanted to move all your manufacturing to the US today, it is physically impossible. So there has to be some kind of negotiation on a global scale of where and how and what the timeline looks like. And so we've had the opening volley to say negotiations start now. We need to get a plan between now and April to make that happen.
Which specific chips names are insulated from the risks of those potential export controls and the tit for tat over tariffs, in your view?
Honestly, I don't see any chip company or any type of company at this point being fully insulated from a risk at this moment. This is one of these moments in history where you look back and you say, I need to make a plan.
Yeah, so that in mind, how are we thinking about the potential impacts to gross production as well here in the U.S.? If we're talking about where some of these chip companies would anticipate they'll be able to generate purchase orders elsewhere around the world and then ship those chips, does that also institute some type of, or at least elicit some type of GDP impact from your evaluation?
So one of the things that we are concerned with is on a global scale, if we enforce tariffs, what kind of tariffs do we see on the other side? So there actually is global risk for how much product gets sold outside of the US, not just the consequences of inside the US. So we do foresee that there could be some slight stall. Now, I don't think that this is a longstanding thing. I'm firmly of the belief that this is still in negotiation play standard, but you have to be running scenarios that say, on the global standpoint, do I expect, for example, there to be a 10 or 20% decrease in China? Do I expect there to be a decrease in the European landscape? So that is actually on the table. So right now, everybody's sitting with their Excel spreadsheets, running numbers, trying to figure out how they make this happen, trying to actually figure out what should be their ask. I imagine it's going to be very busy at the White House between the whole global landscape and all of the US-based companies going to the White House trying to make a play for what they think is the right move. So these are the times when strategy is going to be created. There will be winners, there will be losers, but we absolutely think that there's going to be a shift in the dynamic of both how we see manufacturing happening, how we see the job landscape.
Let's talk about NVIDIA, because we're gearing up for NVIDIA earnings here. And it's going to be interesting to look at the market reaction, because there's this question of risk and whether the bigger risk is in AI earnings disappointing or in DeepSeek proving out their efficiency further. Which of those two do you think has the bigger potential risk for a company like NVIDIA?
If you look at a company like NVIDIA, they can actually sell every chip that they produce right now. The real risk upside for them is, can they produce enough to overperform what the market's expecting of them? The market has had incredibly high expectations for NVIDIA every single quarter. They have blown it out of the park. At some point, we just see a stall, not even because of what NVIDIA builds or because what's built in the landscape, but because of just the ability to assume these chips, build the data centers, have the AI services up and running. So I think we're headed for a disappoint on the AI landscape on multiple fronts. One of them just being sheer data center capacity, energy utilization, buyers buying actual AI services. There's a lag between building and buying, and we have not crossed that chasm at this point.
Maribel Lopez. Maribel, thanks so much for taking the time here this morning. Appreciate it.
Thank you.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street in a little bit. Plus, we've got a look at Nikola as the embattled EV maker files for bankruptcy. And we check in on Occidental as the company falls after earnings. How does Warren Buffett feel about them? We'll discuss that, much more on Morning Brief. Stock futures taking a breather after the S&P 500 hit a fresh record high on Tuesday. Our next guest believes the AI story is still intact in tech, making it his most preferred sector within equities. Joining us now, we've got Jason Draho, who is the UBS Global Wealth Management Head of Asset Allocation. Jason, great to have you here in studio with us.
Great to be here.
So talk us through that positioning that you're identifying right now within tech.
So obviously DeepSeek was sort of disrupted some of the thesis overall for the tech story. But as we kind of step back and look at, I think, the big picture of like what that model entailed, one, it seems like it's really consistent with the developments in these large language models. It looked like it was a game changer, but when you look at kind of the arc of the development of these models, it's still kind of consistent with improvement, lower costs. That wasn't ultimately maybe the bigger game changer. And what we also saw coming out of the earnings season is that the big mega cap companies actually ramped up their CapEx spend. They know what's going on. It wasn't like this kind of caught them necessarily off guard. Yet despite that, they kind of ramped up their CapEx spending. So we're seeing a big increase this year in CapEx spending. The thesis is still very much in play. Maybe the winners and losers shake out a little bit, but the overall thesis, I think, is still on track.
So the AI-driven momentum rally, still on track in your view, but it seems like there's been this kind of rotation under the hood of the S&P. Yes, we're still getting all-time highs, but you're seeing financials contributing more frequently to that. Does that mean that there is a risk to some of those big tech names that's maybe not being fully appreciated by the market, because why not keep riding the momentum?
So I think like we've seen in the past year and a half, periods of time, a couple of weeks, a couple of months, where the markets rotated, you saw small caps do well. You're seeing European equities do well. Those have been under when it's sort of sometimes the momentum goes that way, you got investors kind of chase it, but it's never really been sustained. And so I think one, you need the macro conditions to be very favorable for the sustained rotation towards value stocks, cyclicals, financials like that. So I think that could happen, but every time there's a bit of a hiccup, the tech stocks, these kind of mega cap names are the ones that sort of investors kind of go back to. I think that will continue to play out. And unless there's a real disruption in the earnings story, and thus far, we expect some moderation of earnings growth from incredibly high levels to still really good levels. So I think the thesis hasn't changed. So right now it's a little bit of kind of positioning the markets, a little bit of rotation, more so than a fundamental change in the overall story for either AI or the macro story in general.
It seemed like at the beginning of the year, S&P 500 earnings growth forecasts were largely in consensus at about 15%. Do you expect us to come down dramatically from that level, and if so, where?
Well, if you're talking about 2025, it depends also whether it's bottoms up or top down. I think the bottoms up analysts tend to be a little bit more optimistic, and those get kind of revised lower. Top down, we were at 9%. Based off of the earnings we can see for 4Q, we're about 80% way done the season. Might be a little bit higher than our expectation. So it just sort of shifts the level higher, but our expectation for the S&P this year is 270 per share for the overall index. That implies about an 8 or 9% earnings. Now the guidance we've got from companies for this year has actually been sort of coming down a little bit faster than typical. I mean, typically, companies kind of guide lower than they beat. We know how the game works. It's been a little bit more
sandbagging out there.
A little bit, setting the bar at a level they can kind of clear, right, comfortably. So that bar has been a little bit lowered a little bit more, but overall the story still looks kind of relatively positive for the earnings. So it just depends on kind of where your starting point is. We're still seeing close to double-digit type of earnings growth this year. Nothing in the guidance thus far suggests otherwise.
But it does seem like there's still a bit of disappointment from investors when that guidance doesn't come in and show continued record-breaking earnings growth. Are any dips off of earnings, let's say Nvidia, for example, if they disappoint on guidance and there's a dip in the stock, is that always viable in your view for the big tech names?
Well, it has been viable. If you just look at what's been happening thus far this year, retail investment flows and buying has been very, very strong for the first 6 weeks of the year. We saw it also in the tech space that when there was those pullbacks in Nvidia, retail investors in particular were buying. So I think there's a buy the dip mentality. These stocks have done so well. I think a lot of people feel, if they didn't get in before, if there's a pullback of 15, 20%, that's a chance to kind of re-engage. So until there's a real crack or, significant crack in the thesis, I think those dips will be bought, not only in the mega cap names, but frankly, equities overall. I think that until those people really believe the economy could roll over in some way, then any sort of pullback is great. Now valuations get a little more attractive and we'll put money to work. So I kind of think of it as there's an investor put in the markets. Anything that's, say for the S&P, like around 5,700 in that range, I think you actually get a significant amount of buying, sort of resistance, unless things look like they're really deteriorating in some way.
What about within fixed income? What is the pass-through there as you're hearing from Trump administration that's banging the table about lower interest rates?
Well, it was interesting. About 2 weeks ago, Scott Bessent, Treasury Secretary, came out and said, when Trump is talking about interest rates, he doesn't mean the Fed, he means the 10-year Treasury, which is kind of, I have this idea of there's an other Trump put, not just for equities, but for Treasuries, which means you don't want rates to go too high, so you have to have essentially kind of a floor on the price of Treasury bonds, therefore a cap on interest rates. To have that, you basically can't have policy that's too inflationary. So in some way, it's sort of like, I think the bond.
It's difficult when you're also rolling out tariffs at the same time.
So this gets into like a whole discussion of like, are they credible or not? How much of a negotiation ploy? I think the market right now still believes it's much more escalate to de-escalate, and they won't follow through. There is a risk that, of course, they do, that happens. But it was interesting when those tariffs on Canada and Mexico were announced on the Saturday of 25%. Monday morning when the markets opened, rates went lower, and they actually went higher when they were sort of pushed back for a month. To me, that's an interpretation. The market believes ultimately tariffs will be worse for growth than they are inflationary. The Fed will look through the inflation piece and you're much more about kind of growth slowing down. The uncertainty around it could cause growth to kind of slow quickly. And I think that's what the bond market, that initial 24 hours suggests that. So yes, it could be inflationary, but I think the market sort of view it as more of a growth hit.
But that might be a positive view for the market so long as the inflationary risk doesn't keep the Fed higher for longer.
Well, then you're balancing like what's better, lower rates for the markets or the growth hit. I think the uncertainty at a minimum means you're probably like sideways, you're probably range bound.
Yeah.
Again, if the lower rates, if it's not recessionary, then there's only so far equities could sell off, but it's hard to get really, really constructive on equities as that's kind of playing out.
Really great overview, Jason. Thank you so much for coming in studio with us. Really appreciate it. We're going to take a look at a trending ticker on Yahoo Finance. Now, long-challenged EV maker Nikola has filed for Chapter 11 bankruptcy after failing to raise funds or secure a buyer. The company's downfall has been years in the making, mired by a series of scandals and funding struggles. Back in 2022, the former CEO, Trevor Milton, he was convicted of fraud charges related to misleading investors around the company's operations. And remember, the company is one of our SPAC plays, going public via SPAC back in June of 2020. At its peak, the EV company was valued at $30 billion, more than Ford at the time, which is just a great example in kind of these SPAC plays that were really risky. And you just see that massive run up in the stock following its IPO in 2020. And then obviously just the huge move to the downside following that rout in 2021 into 2022 that they just were not able to recover. As a reminder for folks too, this is an EV play. This is one of those EV names that was trying to compete in the broader auto space here. They were able to sign a multi-billion-dollar deal with General Motors at one point, and they were this kind of darling of the auto space, but clearly falling from grace over the last couple of years amid a slew of financial and executive challenges.
Well, yeah, there's also the self-imposed challenge of going and pitching your product when it's really just a question of, man, this looks so good. Is it actually AI? And turns out it was actually closer to being fabricated and AI than an actual real produced vehicle that the company was going to be able to produce at scale, which became the issue. And so now you have the claims of fraudulence that came forward against Trevor Milton. And then you additionally had larger partners questioning, okay, what would be the timeline to delivery if we did even create a purchase order and decide to have you follow through on that? And so that's the larger impact here. They say, like other companies in the electric vehicle industry, they faced various market and macroeconomic factors impacting their ability to operate. In recent months, they also took numerous actions to raise capital, try to reduce their liabilities, clean up the balance sheet, and preserve cash to sustain their operation. Unfortunately, they say their best efforts have not been enough to overcome those challenges. I
want to end on this stat that I think is fascinating. Almost every EV company that went public via SPAC has failed, which is just such an interesting reflection on that era of financial markets and the amount of companies that were going public via SPAC and kind of the froth in the market at that time coming out of COVID and seeing the impact that it has had on some of those names today. Obviously, not every name that went public via SPAC has failed, but interesting to see kind of the struggles in the EV space in particular.
Yeah, no, I'm taking a look, and one of them came to mind immediately. Polestar. Take a look at shares of Polestar, how far that's declined. That was a $20 billion SPAC deal, I believe. And ultimately, it's trading at 20 cents a share right now?
Yeah, penny stock.
All right, we'll continue to watch all these names, much more, everyone. All your markets action straight ahead. Stay tuned. You're watching Morning Brief.
And that is your opening bell on Wall Street. Taking a look there at Fiverr at the New York Stock Exchange. You've also got the NASDAQ on your screen. Want to take a look at markets kind of sputtering into the trade this morning after hitting another record all-time high, the second of the year on Tuesday. By the way, this time last year, the market had already had 11 all-time highs. So when you put it into that context, the all-time high is not as exciting so far this year, but certainly good news for investors. It's interesting to see kind of the sell-off that we saw on Thursday in treasuries in particular. We saw Treasury yields moving higher following this idea of more inflation to be baked into the market, perhaps a little bit fueled by the commentary we got from President Trump about tariffs to come on autos, chips, and pharmaceuticals. So we will continue to be having conversations about the impact of those tariffs. As I mentioned here, you see a little bit of a sell-off happening in the major averages. The S&P down nearly 0.2%. Your tech-heavy NASDAQ down nearly 0.2% as well. I want to pull up specifically the NASDAQ here because I want to take a look at the chips names in particular here. And it is interesting to see kind of the move to the upside that we're seeing in the chip stocks. In particular, on Tuesday, we saw chips names being the biggest drivers of movement to the upside in chips names. You can see on your screen here, you've got a lot of these big tech names moving to the downside. NVIDIA coming off of its highs from yesterday following that rally in semiconductor stocks, not necessarily driven by any huge fundamental shift in the semiconductor space, but especially given that news I just mentioned on Trump tariffs on chips names, you'd think there'd be more of a sell-off, but we saw a rally starting in those chips names to start the week of trade this week, and then that did continue into the end of the trading day. But here you can see a lot of pressure on those big tech names, Apple and Tesla and Google, all under pressure for your Mag 7 names in today's trade so far. Let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Hey, Maddie. Well, I thought we'd get back to the S&P 500. As you noted, we just hit another record high, only the second of the year. Same for the NASDAQ 100, but we're going very, very slowly. I'll show you the two-day price action, and just really not too much to the upside or the downside. We had a nice bang to the close, into the close yesterday that kind of saved some of the indices from being in the red, but just not a lot of movement, and that's just fine. I think when we have bull markets, a lot of the time, price action is just boring, at least at the index level, not necessarily at the security level. Here's the Russell 2000. That is leading in early trading. Let me show you the 3-month chart there. It's a little bit different. You can see we have these highs over here, and those aren't even the record highs, but we are down appreciably from those, so that's kind of a catch-up trade. Just going to note really briefly that the 10-year T-note yield and the U.S. dollar index both jumping a little bit. The movement isn't that concerning in terms of the risk rally. So I'll just leave it at that, and we'll skip over to the sector action. We had financials leading early. Financials and tech, those actually notched record highs yesterday. We're not seeing either of those in the leadership positions. We're seeing energy leading, and then the cyclical sectors like materials, discretionary, those are lagging today. Materials down, XLB down about 1%. Got to go over to NASDAQ, where I've been tracking Meta. This would be its second down day, and yesterday snapped that 20-day streak that we've been looking at. I'm going to do a deep dive into Meta in about 30 minutes and look into the potential for a bubble comparison, or we'll investigate that. And let me just show you the one-year chart, though. Very impressive, up 48.8% in that stock, just kind of going gangbusters this year. Want to close with the futures market, where we don't have a lot happening. The metals are kind of quiet today. We see crude oil jumping a little bit, but coffee is catching my attention. This is a one-year chart, too. We came off of the highs, had a steep decline a couple days ago. You don't really see it right there. We stayed close enough to record highs that we are just right back there again. 120%, that is a lot. And these coffee prices, these are the input prices that affect your Starbucks and other retail coffee prices. So something we'll continue to monitor here, but just not a whole lot going on in the major indices. Brad?
Jared, thanks so much. Appreciate it. Teeing up today's trading activity perfectly. It's time now for today's strategy session. U.S. stocks pulling back to start off today's session from those record highs that we saw on Tuesday, but with the market trading near its peak, where can investors find their next opportunity for yield? Joining us now, we've got our markets reporter, Josh Schaefer. Josh, where's the next opportunity?
Overseas, Brad, right?
All right.
That was one thing we wrote about this morning in our morning brief newsletter, right, was sort of the catch-up trade people have been finding among global stocks, global equities, actually starting to compete with U.S. equities to start 2025. But one thing I sort of broke down in that column as well, guys, is really It's kind of the same as the catch-up trade that you're seeing within U.S. equities, right? So if we look at the S&P 500 and look at the top performers this year, I'll read through a couple of them right now. Intel, Supermicro Computer, CVS, Airbnb. If we look at all those stocks and thought about what they did over the last year, they all have something in common. They weren't very popular stocks in 2024. And so I think what you're seeing really across the market, across sectors too, when you look at the sectors, materials, energy, some of the best performers in 2025 thus far, what do they have in common? They were laggards in 2024. So you're just seeing a lot of catch-up trade, a lot of rotation, something we were talking about yesterday off the B of A fund manager survey with cash levels so low. Investors aren't leaving the Mag 7 and leaving the market, right? They're leaving the Mag 7 and putting money to work somewhere else. So we're seeing a lot of action in these different catch-up trades. Of course, some individual stories going on there too. I mentioned Intel. There's potential M&A rumors. That's also why people are piling into that stock. But generally speaking, I think we're seeing a clear trend here of stocks that did not perform well last year. People are looking for some way to find outperformance this year, and it's outside that Mag 7 cohort thus far.
And it's interesting, too, given that we are in tax season. I remember Steve Sosnick teaching me that you see some of these underperformers starting to perform really well suddenly in the month of February every year. What does that tell you about what investors are doing with their capital gains taxes? Having said that, Josh, I think it's really interesting to think about kind of where we're seeing the market momentum coming from. And it does seem like we are cementing a narrative that it's no longer driven by those Mag 7 names. Does something like NVIDIA earnings coming up change that? Do we get a return to those Mag 7 names as people look for more of a safe haven trade? It
certainly puts them back into focus next week, right? When we think about the different sort of headlines we have coming at us, I would imagine the tariff headlines are going to heat up a little bit more leading into March next week. But also it seems like NVIDIA is probably the headliner next week, Maddie, yes. And we've sort of been waiting for more commentary post DeepSeek, right? And I bet that's going to be a big focus of that call. I mean, Mag 7 earnings outside of NVIDIA didn't really do a lot for that cohort, right? Save Meta, which has done very well this year, and the market seemed to like their earnings. Earnings haven't been that friendly to the group thus far, so it'll be interesting to see how it works for NVIDIA. I mean, NVIDIA, even the last couple quarters, hasn't necessarily seen a big pop in its stock, right? You look at NVIDIA shares over the last couple weeks, it's been on this trend of rallying into earnings, but not necessarily rallying post earnings. But we know what they say can sometimes drive a little bit of an AI narrative. But I would argue, generally speaking, the AI trade is still performing. It's just not really the Mag 7 at this point.
I want to come back to what we can effectively call your passport trade a hot second ago here, because this was something that was also evident within what Macquarie was saying, and that hit our inbox yesterday, talking about globally they see areas of opportunity, valuations outside the U.S. more attractive, economic stability scarcer though. They did warn and caution here, and I wonder how traders are kind of balancing that, the economic side of the potential instability of some of those markets versus where the valuations present an opportunity.
Yeah, Brad, so the valuations definitely present an opportunity, right? And then, as you said, sort of the variable is economic growth. But one thing that was interesting that I was looking at yesterday, if you look at sort of just consensus projections for the Eurozone or for UK economic growth, GDP growth, it's supposed to tick up slightly in 2024. Into 2025, if you look at the US, we're supposed to come down, right? And very often in investing, we're talking about rate of change, not necessarily level, right? Where is my growth increasing? So I think part of what investors are seeing across the globe is, okay, across the globe, economic growth hasn't been that great in a lot of areas for the past couple of years, not nearly as strong as the US. But if it's going to pick up, then perhaps that's my area of opportunity. Again, you mentioned a lot of variables. We haven't even gotten to the point of talking about Euro tariffs yet, right? And what if we start tariffing those countries, and how does that impact them? But just generally speaking, they're coming off a lower level, so there's perhaps more room to outperform. When you're looking at the US economy, we're expecting about 2.2% annualized GDP growth. There's not a ton of room to outperform there. I mean, there is, but that would be very impressive from the US economy. So we're sort of priced in a lot of positive growth here, and people are arguing outside of the US, we haven't priced in a ton of good news. So maybe there's opportunity for some more good news to come in and actually be a catalyst there. We've already had a lot of strong catalysts here over the last couple of years.
Certainly. One of them, though, that's a big question mark, and I love this line from BNP Paribas saying this morning that the Fed is comfortably numb right now, and that's not necessarily going to be a catalyst for Wall Street this year. So something we'll continue to monitor. Josh, thank you so much. Appreciate it, as always. Well, President Trump's economic team is focusing more on Wall Street and less on the Federal Reserve. Here to break it all down, we've got our Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. Treasury Secretary Scott Bessent again pushing the administration's strategy to lower long-term borrowing costs for Americans by pushing down the yield on the 10-year Treasury. Comments he made again last night during an interview on Fox News. At the same time, National Economic Council Director Kevin Hassett also pushing that narrative over the weekend, saying if we can get inflation back down, that could take pressure off the Federal Reserve. Now, officials intend to try to push the yield down on the 10-year through policies that promote economic growth, productivity, and cutting government spending. Now, yields move inverse to price, so inflation tends to drive up yields as investors demand more compensation since inflation erodes the value of a bond. James Fishback, CEO of investment firm Azoria, says he believes the policies will lower inflation and boost growth, acting to push down the 10-year yield. He points to Elon Musk's Department of Government Efficiency, which he believes will trim wasteful spending and reduce fiscal pressures that can push inflation and yields higher. Now, Musk said on X that, quote, as it becomes clear Doge is working, you will see the long-term Treasury bill yields fall. Wilmington Trust portfolio manager Wilmer Stith said he believes Bessent's biggest tool for lowering the 10-year bond yield is to lower the deficit, pointing to Doge, and thus lower the supply of Treasuries. The Treasury Department indicated in its quarterly refunding statement on February 5th that it's not expected to increase the amount of Treasury supplies for at least the next several quarters. Now, tariffs could be a wild card depending on whether they prove inflationary. LPL Financial says initially tariffs could actually push yields lower as investors treat treasuries as a safe haven during uncertainty. However, if we see substantial retaliation and escalation and those tariffs do prove inflationary, then yields could ultimately move higher. Guys?
Jennifer, thank you. Coming up, everyone, the outlook for oil this year, what it means for energy companies, and one big bet by Warren Buffett. That's next on Morning Brief. Occidental reporting mixed fourth quarter results, beating on earnings but missing on revenue. The energy company also announcing 2 deals in the current quarter to divest some of its upstream assets to undisclosed buyers for $1.2 billion. Joining us now, Stuart Glickman, who is the CFRA Research Energy Equity Analyst. Great to have you here with us. Just first, want to get your reaction to the results.
Thanks, Brad, for having me. So results pretty good. They beat handily, 80 cents on the quarter, well above the 67 cent consensus view, and actually better than last year's at 74 cents. I think Oxy is doing a pretty good job at sticking to its knitting and delivering as best it can. In an environment where oil prices have been choppy and natural gas prices have been somewhat choppy. But as far as the print goes, pretty good results.
So pretty good results, but as you mentioned, there is this challenging macro backdrop for any company in the energy space right now, given the pressure we've seen on crude prices. To what extent do you think that continues to be a challenge for Occidental moving forward?
Madison, great question. So I think all you have to do is look at OPEC Plus and see what they've been doing over the last several months, which is continually pushing back the start of the unwinding of the 2.2 million barrels a day of voluntary production cuts. Why are they pushing it back? They're pushing it back because they're concerned about demand, and they are worried about flooding the market and sending prices plummeting through the floor. So I think there are real concerns about where incremental oil demand is going to come from. The Chinese economy looks pretty wobbly. India is growing, but India is not anywhere close to the size of the Chinese economy. And Western markets, year to year, don't improve demand all that much. So if you're not going to see a lot of growth coming from Asia Pac, where are you going to get those incremental barrels from? That, I think, is the backdrop that people are concerned about. Certainly OPEC Plus is concerned about it. And the U.S. oil community, as stingy as they're being about developing new oil and gas, or their organic spending is really not particularly strong, they are still delivering production gains year on year. We think the U.S. probably averages around 13.5 million barrels a day of oil production in 25. That's up a little bit from about 13.2 in 2024. So you've got growing non-OPEC supply. You've got OPEC Plus holding off because of concerns about demand. And of course, the the demand concerns. All of that points to a backdrop where we don't think oil prices are going to be all that attractive this year. We're looking at something like $65 a barrel for WTI.
So what's that pass-through mean for Occidental here, especially as it's a stock that's been down 14% over the past 52 weeks. It seems like a lot of it has been kind of buoyed by the Buffett narrative and his buying. But outside of that, where are the other major catalysts for growth that you're anticipating to come to fruition?
Right. So Oxy has a couple of irons in its fire. One is the Crown Rock acquisition that they completed in mid to late 2024, adjacent to a lot of Oxy's other acreage. And that's important because when you have adjacent acreage, you can run longer laterals, you can squeeze down unit costs. We've already started to see that in Q4. Oxy was able to eke out about an 8% unit cost reduction on those Crown Rock assets. As they get to know the acreage a little better, there's a chance that they can probably squeeze out a little bit more. So that's a plus. They're one of the leaders in the industry in carbon capture sequestration, which is another plus for the industry. Certainly nobody wants to, send excess carbon up into the environment if you can avoid it. So those are pluses that they have that are kind of under their control. The things that are the concerns for Oxy, of course, are the macro backdrop issues that I pointed to, and Oxy also has to contend with a somewhat levered up balance sheet. Right, their net debt to cap is around 42% right now. That's materially higher than the average E&P. Most E&Ps are going to be closer to 30% or a little bit less. So we talked about just earlier in your intro, you talked about some non-core asset sales. I think the reason for that is that they're going to use those proceeds to help get that balance sheet back under control. Higher oil prices would help, but you can't count on that, of course.
And just lastly, while we have you here, Stuart, just to follow up on the Buffett effect here, how much do you anticipate that investors are actually expecting Warren Buffett to continue to buy into Occidental, even with the allocation that he already has within the Berkshire Hathaway portfolio, and now trying to figure out, okay, even if we do see even more continued slippage, what he would feel comfortable continuing to allocate towards Occidental?
Yeah, Brad, that's a really tough question to answer. He's certainly mercurial. Hard to know, when, of course, he's going to step in and add to his position. I think that, certainly Warren Buffett has always been sort of like a believer in the long-term picture for any company that he invests in. And so him investing more into Oxy isn't necessarily a view that, the next 12 months are going to be great for Oxy. It may just be that, he's thinking about the bigger picture longer term. And to be fair to Mr. Buffett, I think longer term, the outlook for a lot of energy companies is pretty good because the lack of spending at the oil field is going to eventually come back to bite. Non-OPEC supply growth isn't always going to be positive. So we could, perhaps by the end of the decade, start to see oil production roll over because of that lack of spending. I just think that from a near-term catalyst perspective, this year looks more of a headwind kind of year than a tailwind.
Really good analysis as always. Stuart, thanks so much for taking the time here with us today.
Thank you.
We've got much more of your market action after the break. Stay tuned. CEOs for 5 of the country's largest Wall Street banks all saw pay bumps in 2024 compared to the year prior. But one stands out as the largest, and here with the reveal, we've got Yahoo Finance banking reporter David Hollerith. David, what'd you find?
Hey, Brad, we now have compensation for 6 of the country's biggest Wall Street banks executives. And Jane Fraser, Citigroup CEO, stands out as having total pay that has seen the largest increase from last year. Fraser received $8.5 million more, which made her compensation come in at a total $34.5 million for the year of 2024. So again, their compensation's paid on their performance or their bank's performance also from last year. Now, Fraser's award also comes as her as a consecutive year rise in her pay. It's also higher than Wells Fargo CEO Charles Scharf and Morgan Stanley's newer CEO Ted Pick. The two big bank CEOs who came in with the highest total compensation were Goldman Sachs's David Solomon and JP Morgan Chase's Jamie Dimon. They both had $39 million in total compensation. So again, actual payment in turn comes in a mixture of cash and stock incentives and performance units. And the actual base pay of cash for all these executives ranges between $1 and $2 million to $3 million. So we do have a range there, and they can't necessarily spend all of this money in one year. But it is notable that Fraser saw such an increase. She's trying to lead Citigroup through this multi-year turnaround effort, and things weren't all perfect, but she did definitely show improvement, and the board compensated her for that.
Exactly what I wanted to follow up on, David. It is interesting to get that degree of a pay increase when you are in the midst of cost cutting at your own firm. What do you make of that kind of cognitive dissonance at Citi?
Yeah, I mean, I think that just judging from the filing, what the board has pointed out is that she's been prompt in executing on her targets. And it's also notable to point out just in July, Citi was hit with another regulatory order related to they're not addressing quickly enough some data issues they've had, and they've talked a lot about that, and Fraser's addressed it. So there is some tension here about whether or not Citi can actually execute. They're also they tailored back an efficiency target that Fraser had previously set, but they still are making strides. And the turnaround efforts for Citi is sort of a decade-long conversation. And so it seems like the board is at least backing her and supporting her compared to that. Again, Fraser had the lowest pay in 2023. So this is a significant jump, and it shows that the board at least is supporting her decisions.
All right, David, thank you so much for joining us and breaking that down. We appreciate it. That's going to do it for Morning Brief. You can join me in the next hour for more analysis on Catalyst and Brad at 11 a.m. Eastern for all of your wealth news. So keep it here on Yahoo Finance for more.